Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Cisco Systems Inc., ticker symbol CSCO. We're looking at Cisco because it's a subscriber request. So Cisco is one of these businesses that was a tech darling during the tech bubble in 1999 and 2000. Cisco is considered such a darling that its stock price even today has never returned to where Cisco was in spring of 2000. Currently, Cisco is trading for $45.43 per share. Over the past year, their stock price is down 19%. Over 5 years, Cisco is compounding at a rate of 5% annually. Over 10 years, they're doing even better than that, compounding at a rate of about 9% annually. And going back prior to the global financial crisis, over the past nearly 18 years, Cisco has compounded at a rate of about 5% annually. Keep in mind that this stock price return is not including their dividends, and currently Cisco is paying out about a 3.3% dividend yield right now. So Cisco is trading about $7 over their 52-week low. They're down about $20 from their 52-week high. Cisco is a very large business. They have a $187 billion market cap. For additional background about the company, Cisco Systems is the largest provider of networking equipment in the world and one of the largest software companies in the world. Its largest businesses are selling networking hardware and software, where it has leading market share, and cybersecurity software like firewalls. Cisco also has collaboration products like its WebEx suite and observability tools. It primarily outsources its manufacturing to third parties and has a large sales and marketing staff, which is more than 25,000 people strong across 90 countries. Overall, Cisco employs 80,000 employees and sells its products globally. Cisco also has a number of strategic alliances with other companies. Cisco Systems Inc. was founded in 1984 and is headquartered in San Jose, California. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Cisco based off of their business fundamentals. So this analysis is still an evolving process. It will continue to improve and get better over time, and it serves as an opportunity to learn in public, So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. And the average publicly listed business earns about a 7% return on capital. So by asking for businesses that are earning 14% on average or higher here, we can potentially build in some margin of safety for ourselves based off of the overall quality of the business. Cisco earns very steady above average returns on capital. They've managed to increase their return on capital over this time. And over their last 12 months, they're earning about 28% returns on capital. Averaged out over the last 5 years, Cisco produces 25% returns on capital in a given year, which is close to double the metric we were looking for and nearly 4 times better than that of an average business. So this is a massive check to start off on metric number 1. Metric number 2, here we're taking a high-level overview of the cash coming into the business. We want their revenues, earnings, and free cash flows to have grown over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. Cisco has managed to grow their revenue slightly over this time. They had a very atypical year in 2018 for their earnings, where their earnings were significantly down due to income tax expenses. Even so, backing out that expense, they've managed to grow their earnings over this time. However, Cisco's cash flows are very slightly down just about $70 million on almost $13 billion in free cash flow from 2018 to 2022. And so unfortunately, even though this is very, very close here, this is going to be an X on metric number 2 because their cash flows are down over this time. Metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Cisco on a per share basis. So we're looking for 5-year earnings per share growth here. Again, they had this big income tax expense in 2018, which makes their earnings per share look very skewed. However, even if they wouldn't have had that, they'd still have grown their earnings over this time. Additionally, what's nice for existing shareholders is that Cisco has repurchased about 14% of their shares outstanding in the last 5 years alone. So this is fantastic as a long-term shareholder in a business, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that business. When a business buys back stock by decreasing the number of shares that they have outstanding, they're actually increasing your ownership percentage in the business, which is going to increase the percentage of the business's profits that you're entitled to. So it's almost as if the business is making an acquisition of itself. So as an existing shareholder in the business, you want a company to be buying back shares when they're trading below their intrinsic value. And in comparison to their opportunity cost, they're able to add value going forward for existing shareholders. Coupling their earnings growth with their buybacks means that they've had earnings per share growth here. This is going to be our second check here on metric number 3. Metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. So even though their free cash flows are down just a very tiny amount over the last 5 years, because of their buybacks, Cisco has managed to increase their free cash flows per share. This means that their free cash flows per share are up over this time period. So this is another check here. So far through our first 4 metrics, we are 3 for 4 on Cisco. Next up for metric number 5, we're evaluating how the business is utilizing leverage. So we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that they produced over the past 5 years. Cisco currently has negative $8.7 billion in net debt, which means that after paying off all of their liabilities, Cisco is sitting on nearly $9 billion of cash. Coupling this with the fact that they are strongly cash flow generative, Cisco seemingly has a very strong balance sheet position here, and they would look to be in very sturdy financial shape. So this is a big check on metric number 5. The business has more cash than they have debt in total. And so through our first 5 metrics, we have 4 checks and only 1 X. Our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a slight risk premium to the yield of the 10-year treasury and give us another reason to potentially be interested in the business. We're using their total enterprise value because it's going to give us a more economically accurate picture of the business than their market cap would alone by taking into account both their market cap and their net debt position. So it'll be more similar to as if Cisco were a private company. Currently, Cisco has about a $179 billion total enterprise value, and we learned that over the past 5 years, Cisco has produced $70 billion in free cash flow. This means that in an average year, Cisco's producing about $14 billion of free cash flow. So when we divide their average free cash flows of $14 billion a year by their $179 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of approximately 8.2%. So that's a potentially sizable risk premium above the rate of the 10-year treasury. It's nearly double where the treasury rate is at currently, and it's above that 5% mark we're looking for. So on a historical basis of their average free cash flows, this is a check here on metric number 6. Also worth being aware of is that over their last 12 months, Cisco has produced slightly less free cash flow than where they've been at historically. They produced $12.8 billion of free cash flow over their last 12 months. So to get a current free cash flow to enterprise value yield for the business, when we divide their $12.8 billion of their last 12 months of free cash flow by their $179 billion total enterprise value, that gives us a current free cash flow to enterprise value yield of approximately 7.5%. So even on this basis, it still potentially looks like it's attractive here for Cisco. Keep in mind that this is just one data point and that we want to consider Cisco as a business holistically. So we're going to continue learning more about the business. Then here we're taking a look at Cisco's dividend profile. So Cisco currently pays out a 3.3% dividend yield, which is well above that of what an S&P 500 ETF would be yielding right now. However, it's important to stop and consider the underlying fundamentals of a business and not to blindly chase dividend yield. People make mistakes all the time by doing so. So in the case of Cisco, you want to make sure that their dividends are well supported by their cash flows. In all 5 of these years, this looks like this was the case. And given the fact that Cisco has a negative net debt position, meaning that they have excess cash left over on their balance sheet, Cisco seemingly would have plenty of room to continue growing their dividends at what has been a modest pace and still have it be conservative relative to their cash flows. So if you're potentially interested in Cisco for its ability to be a dividend growth stock over the long term, while these dividend increases in the past have been modest, it looks like if they're able to sustain their cash flows going forward, that this could seemingly be the case. Past performance is not an accurate predictor of future performance, even if Cisco's past 5 years have been pretty good for the business here. Then finally here we're using a discounted cash flow model to come to a potential fair value for Cisco. So starting with their current free cash flows per share, and then projecting growth and terminal stages out over the next 20 years for the business based off of their historical abilities to grow their free cash flows over the past 20 years. So these are historical assumptions that you need to confirm or disconfirm for yourself, whether or not these are going to be potentially applicable for a baseline projected estimate of Cisco going forward. So using those assumptions with a growth stage over the next 10 years where Cisco grows their free cash flows at a rate of approximately 8% annually, and then using a terminal stage over the next 10 years out after that where their growth rate falls in half to only 4%, we're not going to be adding in their tangible book value because that's skewed based off of how accounting is done for the buybacks that Cisco has done. Then if you were looking for a 10% rate of return potentially out over the next 20 years, it looks like a fair value for the business would be about $46 per share. So that fair value is 50 cents above where Cisco's current stock price is at. So it does look like if you're satisfied with this rate of return, and if you've done the work to understand whether these assumptions are going to be applicable, that you could reasonably expect a 10% rate of return going forward on Cisco. Keep in mind that this would be including their dividends, so their stock price would not be fully appreciating by this 10%. Also, please be aware that this type of analysis is not financial advice. It is not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. So in summary, Cisco Systems checks the box on 5 out of 6 metrics. They were very, very close to being a perfect 6 out of 6 on our Select 6 analysis. However, their free cash flows over the past 5 years are just very slightly down just a few percentage points over these years. However, Cisco is earning quite a bit above average returns, coming in at about 25% returns on capital in a given year. Their revenues and earnings are also up over this time. The company has managed to buy back 14% of their shares outstanding in the last 5 years alone, which means that even with their free cash flows being down, both their earnings per share and their free cash flows per share are actually up due to those buybacks. Then the company has about $9 billion left over in cash after paying off all of their liabilities, and they're strongly cash flow generative. On both a current and an average basis, the company looks like it's potentially offering an adequate risk premium to the rate of the 10-year treasury in comparison to their total enterprise value. Cisco is also conservatively paying out a 3.3% dividend yield right now, and it looks like based off of their abilities to produce free cash flows that they could realistically keep growing their dividend for a while to come into the future. Then finally performing a discounted cash flow analysis of Cisco based off of their current free cash flows, then using historical growth assumptions for the business, which you need to do your own homework on to verify whether or not those are going to be applicable. That Cisco looks like it would be approximately fairly valued today if you were seeking a 10% rate of return over the next 20 years. Again, that would be including their dividends, so their stock price would not be appreciating by that much. Also keep in mind that this rate of return would be about 3% better than what Cisco has done over the past 18 years. So you'd have to make the assumption that Cisco is undervalued today for that to be true compared to what they've done historically. It's worth reiterating that this analysis is not financial advice and it's not a buy or sell recommendation of any security. Before you consider any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. This analysis instead serves as a holistic and beginning understanding to help you determine whether it's worth your time and energy to dig in and learn more about Cisco Systems going forward. If you're interested in learning more about the business, I would highly recommend starting with their filings. You can read through their 10Ks to get a history of the business and their operating results. Management will also lay out some of the potential risks that the company faces, and you'll get a better understanding of both the business operations and their strategic decision-making going forward as it pertains to capital allocation. When you're finished reading through their 10Ks, I'd also recommend reading through their 10Qs and their proxy statements to get a better understanding of how management is incentivized and to determine to what degree does management's incentives align or misalign with shareholders. When you're finished going through all of those, you can also read through some of the recent quarterly earnings call transcripts that the company puts out, where you'd potentially find that some of the Q&A questions that analysts asked Cisco would be interesting and would potentially provide you with a more nuanced understanding of the business going forward on a quarterly basis. So as a value investor, you're ultimately trying to conduct your research as if you're going to own 100% of a business, and you can truly determine all of the ins and outs of a company and understand its underlying essence. So as you learn more about both the quantitative and the qualitative aspects of Cisco, you'll be able to identify for yourself what a potentially appropriate intrinsic value for the company will be, and that can better inform your investment decisions going forward. So with that said, that's it for today's fundamental stock analysis of Cisco Systems Inc., ticker symbol CSCO. As mentioned, Cisco was a subscriber request, so I'm happy to make an analysis of it. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Cisco with me, and have a great day.